Are you exhausted of searching for your dream trading strategy? Have you been losing money trading in the markets and can't seem to find a way to turn things around? You have seen hundreds of videos on YouTube, but none can help you? If so, then this brand new series is for you, because I will be taking you step by step throughout the whole process of creating a profitable trading strategy. I will share with you exclusive information that you will not find in any other video. So, if you are ready to take your trading game to the next level and start making consistent profits in the markets, join us on this exciting journey. For those who don't know me yet, hello, my name is AlgoTrade Pro and I am a professional trader specialized in algorithmic trading. Throughout this new series, I will not only teach you all the process behind a great strategy, but I will also create a new one from scratch that all of you will be able to use by the end of this series. I will create the strategy based on an algorithmic approach that will later be fully automated, but keep in mind that you can do everything I will do 100% manually. Before thinking about the indicators that we are going to use or the most appropriate risk management strategy, it is necessary to answer some basic questions. The first one being, what kind of strategy will you want to use? A scalping, day trading, swing, or even position trading? In my case, I will want a mix between day and swing trading. This may sound strange, but later in this video you will understand why. Based on your decision, you will then answer the second question, which is, what time frame do you want to use? Here your choice will be related to your answer to the first question. In my case, I will choose the 2-hour time frame. I know, it's not something you usually see, but I'm already quite used to working with it. And for me, it's more consistent because few traders use it, and that's exactly what I'm looking for, to be out of the average. Throughout 2022, I also used a strategy on the 2-hour time frame, which proved to be very profitable. If you want to know more about it and see my trading journal with all the trades I took, I will leave the link to that video in the description, so you can go watch it after this one. Another important question is also, in which markets will you want to apply the strategy? Here your decision is again 100% personal and will meet your trading wishes. Keep in mind that you can even choose more than one market to create the strategy. It can be more challenging, but you get a more balanced strategy. In my case, as I already have a strategy for the Forex market, I will create a trading strategy for the cryptocurrency market. After knowing the market you want to use, you should define in which assets do you want to trade. And here, the more diversified your choice is, the better. For example, for Forex, you can choose some pairs with high volume, taking into account the 8 major currencies. For the strategy I am going to create, I will initially choose 7 cryptos with a high market cap, but later I can add some altcoins to diversify my risk. I will choose the following cryptos: Bitcoin, Ethereum, XRP, Cardano, Litecoin, Chainlink, and Stellar. If you have trouble answering these 4 questions, you can get information wherever you want. You can look for articles on the topics, do searches on Google, watch other videos on YouTube, or even read books on the subject, and sooner or later you will find what is best for you. Then you should choose a platform that you will use to perform your backtests to create your strategy. And it should be simple with a vast amount of data and options. My advice for you is using the TradingView, which in my experience is by far the best platform you can use. It's easy and intuitive for beginners, yet powerful enough for advanced users. And the best part is that you can use it for free. In the description of this video, you can find an access link that gives you $30 free to use if you want a discount on a premium plan on TradingView. And so, the first steps towards creating your trading strategy are taken. We can now move on to the phase of choosing the indicators for our strategy. As I already mentioned, I will create a strategy with an algorithmic approach that is formed by a system of different types of indicators, which, in my opinion and experience, is the best option for any trader, especially if you are a beginner one. And why, you ask? because by using an indicator system that tells me when to enter and when to exit a trade, I completely eliminate the emotional factor that trading brings. In case you don't know, statistics tell us that 90% of traders lose money when trading in the markets, and 80% of them are due to a lack of psychological management. As such, an algorithmic approach based on an indicator system puts us ahead of 90% of traders. And no, I'm not saying this just because it sounds good, it's really true. Our trading system will be based on 5 types of different indicators. Today, I will share 2 of them with you, the first being the ATR indicator and the second a confirmation indicator. The average true range or ATR indicator, for those who don't know, is a technical indicator used to measure the volatility of an asset's price over a specific period of time, and therefore is the best indicator that exists for the risk management of our strategy. And how should you use it? Well, it's quite simple. As you can see, after the close of each candle, the ATR gives us a value, which is the average number of pips that the asset's price has moved per candle in the last 14 candles. And it will be this number that will be used to calculate how far our stop loss should be from our entry point. The more volatile the market is, the higher this number will be, and therefore the higher our stop loss will be. And the opposite applies when the market is less volatile. For my strategy, I will want to use a constant of 1.5 to calculate my stop losses, because after a brief analysis of the movement of the cryptocurrencies that I have chosen, it seems to me that it is the best option, as it often matches with the last swing low for long positions and the last swing high for short positions. In this way, each stop loss will be calculated based on the formula 1.5 times the ATR pip value. Of course, at the end of the strategy, we can test other constants. The confirmation indicator is intended to tell us when to enter and also when to exit from a trade. As such, it must be a balanced indicator, which does not give us entry signals either too early or too late, which keep us in a trend for the time necessary to have the highest possible returns, and which has an acceptable win rate, ideally close to 60%. In today's episode, I will show you how to test confirmation indicators and how to know which one is the best for your strategy. Before that, let's just establish our take profit criteria. For all the trades, we will have an initial take profit, where we will close 50% of our position and place the stop loss at the entry point of the trade. This first take profit will be at the 1 times the ATR pip value zone. Throughout my career, I have tested countless ways to take profits, from having only 1 to having 4 or 5 levels, but the way that always allowed me to make the most profit of trades was the use of a trailing stop loss. As such, for this strategy, we will apply a trailing stop loss for the other 50% of the position. This trailing stop loss will always be 1.5 times the ATR pip value behind the price. And for now, the second half of the trade will only be closed if our confirmation indicator gives a signal in the opposite direction of our trade, or if the trailing stop loss is activated. This is one of the best ways to take profits, as we hedged our trade early and then let it run. And believe me, whenever good trends are caught, the profits of the second 50% of the trades can be very pleasant. And although the first take profit will be in the risk-reward zone of 1 to 0.67, the average risk-reward of the trades is often above 1 to 1.5, due to the second half of the trade having no take profit. The first take profit is used only to protect the trade, because in case you didn't know, a good trader is the one who knows how not to lose, instead of how to win. And why? Because, as someone said, we win by not losing. In future episodes of the series, you will find out that there is another way to increase your profits, but for now, these are our criteria. I remind you that I will want to create my strategy like this, because for me it is what works the best, but you can do it as you wish. So now I'm going to tell you how you should do your backtests. If you don't know, backtesting is a method of simulating a trading system on historical market data, and with that, you can discover how your strategy will perform in the past. When a trading strategy works, it is not because it has perfectly described a mathematical principle, but rather because it has captured a particular market characteristic that produces a positive return over time. It could be said that there is no absolute certainty that a specific trade will be a winner, but you can establish that over time, following your strategy set of rules will have you turning a profit most of the time. This is really where backtesting is crucial. But there are a few mistakes that the majority of traders do when backtesting. The first one being the use of a small amount of data, and as such, it does not validate the real efficiency of the strategy. And the second one is the over-optimization of the strategy on a certain number of data, making what is called overfitting. But I have a solution for you to avoid making these types of mistakes, and that is the establishment of data samples. As such, before starting any backtest, you should establish data samples. To do so, and taking into account the time frame you choose in the second initial question, you should find out how far you have data. If you use the trading view, you must click on the icon that says Go To and put a very old date, for example with the year 2000, and press Enter. And the trading view will show you how far it has data for you to use. In my case, and in the Bitcoin 2-hour time frame, it is until 2016. Notice that if in your case you don't have so much data available, the same is due to the plan you have. As I am a user of the TradingView Premium plan, I have access to all available data. Once you know how far you have data, you must define two types of samples, the in-sample data and the out-of-sample data. The in-sample data will be used for all backtest stages for the creation of the strategy, while the out-of-sample data will be used only at the end of each phase to check the consistency of the strategy. I won't say much more about this topic because you can find a lot of information about it on Google. What you need to know is that the more the results of each sample are similar, the better the consistency and efficiency of the strategy are. And if they differ a lot, it means that your strategy is probably overfitted, and as such, you will have to make small adjustments to change this situation. In my case, I will want to use data from 2019 to 2022, and I will split the data as follows. My in-sample data will consist of the data from the years 2019 and 2021, and my out-of-sample data will consist of the years 2020 and 2022. It's only 4 years, as some cryptocurrencies don't have much more data available. But, for example, in the case of my Forex strategy, I use data from 2010 to 2021 to create my samples. Again, you can create your samples however you like, and the more data you use, the better, because the results will be more consistent. As such, we are now ready to start backtesting. I remind you that today I will only test confirmation indicators, and I will choose the best and more consistent one. I will use the 7 cryptos that I mentioned at the beginning of the video in all backtests. I will use the in-sample data with information from the years 2019 and 2021, and I will use the risk management rules that are defined based on the ATR indicator. I will analyze as many indicators as possible, and I will be right back. Here are all the results. As you could see through some clips I was showing, I used my backtesting bot to help me, but everything I did you can also do manually. I tested about 30 different confirmation indicators and put them in this table to compare them. Here there is no specific number of indicators to test, But the more you test, the better, as you increase the probability of finding good indicators. As we can see, my top 3 indicators for the crypto market with the highest win rate were the Supertrend, the UT-bot and the KQE MT4. Note that depending on the change in the sample, risk management, timeframes or markets, the performance of the indicators can change completely. So don't be guided by my results if you are going to create a strategy different from mine. Now, to find which one of these 3 indicators is the most consistent, I'm going to apply them to my out of sample data. I will do it again using my backtesting bot, and I will be right back. And here we have the result of both samples of the 3 best tested indicators side by side. In this case, it is easy to verify that the most consistent indicator is the KQE MT4, which maintained its efficiency in the backtest on the out of sample data, and, as such, will be our confirmation indicator. In the case of the Supertrend and the UT-bot indicators, both net profits had a big difference in the 2 samples, and we don't want that to happen, because it shows that the indicators are not very consistent. If by chance the 3 indicators were not consistent, we could choose the best one and change its settings to optimize it in both samples. Ideally, the different stats should have a difference of less than 15 to 20%. For now, our strategy with the KQE MT4 and ATR indicators has an average annual profit of 280% with 2% risk per trade, has an average win rate of 57.22%, and gives us around 254 signals per year and per cryptocurrency. Of course, you will see that this statistic will still change a lot over the next episodes of this series, where we will include other types of indicators to improve its efficiency. But it's already an amazing starting point. Note that I will still analyze many other statistical aspects and, in the end, I will simulate the results taking into account the commissions that we would pay in a real account for each lot used, in order to have the closest results of what will be the performance of my strategy in a real trading account. And so ends today's episode. Next week, we will address another indicator that will make all the difference in our strategy, and I will again perform several backtests with my samples, and I will show you the whole process. So don't forget to subscribe to my channel and turn on the notifications so you don't miss any episodes. I hope you enjoyed it, and above all that you learned something new. And I wish the best of luck to those who are going to start their backtests on confirmation indicators. If you want to speed up that process, you can access my backtesting bots, which can backtest thousands of trades in a few seconds. For more information, check the links in the description. I look forward to receiving your feedback. You can do it through the comments here on YouTube or through the public Discord group. I will be waiting. And that's it. Again, don't forget to subscribe, share and like this video to support me in bringing more content to you. Be well, thank you, bye bye.